Good afternoon, and welcome to the Stock Market Show. My name is Brian Schwieger. I'm the head of equity trading at the London Stock Exchange, and this afternoon I'm going to be speaking to you about one of the most important parts of our trading day, but which perhaps are least understood by the individual investor. Our auctions. Auctions are a time of day when we bring together a large number of buyers and sellers to take part at one time, to take part in one trade at one time, at one price. They're very popular with fund managers. They tend to use them, as we said, in terms of valuing their portfolios, valuing the index, but they also use them to take part in some of their larger trades. However, our research has indicated that by and large, individual investors are very unaware of these auctions, and as a result, don't actually use them in their own trading strategies. So really my aim today is to give you a little more information and hopefully start to bridge that information gap and perhaps even convince one or two of you to actually use auctions in your day-to-day trading. So over the next 20 minutes or so, I'm going to be taking you through what auctions are, how they work, how they relate to the trading day, and perhaps most importantly, why you might be interested in using them. And in terms of that last point, why you might be interested in using them, I think this chart here starts to give you an idea why we feel that you should be more aware about auctions. So this chart takes you through a very basic view of the trading profile of a set security. Now, for those of you who aren't aware, we actually operate a number of different trading platforms at the stock exchange. Perhaps the biggest really is our sets. So this is the electronic order book where all of our members can come together and can trade and put orders on and off the order book. We have other platforms which are market maker driven, where you actually have to deal with the market maker. But these are the securities which are perhaps the most popular and certainly the most well known to you in terms of trading. And as you can see here, in terms of the opening auction, we see about 1% of a day's trading. 75% takes place in what we call continuous trading, so that's really between the hours of 8 and 4:30. We have something there called the EDSP auction. I'll touch on that a little bit more later, but this is basically a special auction that we run once a month for the valuation of options, etc. And then you can see there on the closing auction, this is one of the busiest times of our trading day, 23% of daily volume takes place in the closing auction. I think I'm going to give you one more stat just to really underline the importance of auctions. So when you look at that there and you do up the numbers, it's about a quarter of a day's volume takes place in our auctions. Now when you actually think about how long auctions last, if you look at our total trading day, which is about roughly 8.5 hours, auctions actually only account for 3% of the trading day. So in 3% of the trading day, we're actually trading a quarter of our volume. That's why we think that auctions are something which are very important in terms of obviously our day-to-day trading, but also something which we really feel that the individual investor should know more about. So auctions, as I said before, are the bringing together of a large number of buyers and sellers at one place, one time to take place in one trade. And because of that aggregation, because we're bringing together so many people at one time to trade, they prove to be very popular with fund managers, as I said before, in terms of trading larger orders. And the reason for that, if you think about it, if I can trade a larger order at one time with a lot of other people coming together, I'm minimizing my market impact. So this is why you see a lot of fund managers, particularly in the closing auctions, will actually come in with portfolios designed specifically for trading in that auction. Now, the key to any auction is what we call the call period. Now, this may sound counterintuitive, but in a call period, we stop trading. We completely stop trading, we freeze the order book, and during this period, which again, I'll touch on in a few minutes, but it varies between 2 minutes to 10 minutes, depending on which auction. During that call period, that's when we're collecting in all of the orders from the market, and at the same time, we're also calculating the price at which we're going to be able to trade. Because of that aggregation, because we're bringing everyone together and everyone is actually contributing to the price formation at that point in time, we consider it to be a very democratic way of trading, if you like. So, for example, The individual investor who may have only read about the stock 2 weeks ago and decides that they want to get in and trade will be trading at the same time, at the same price as a fund manager who may have been studying this stock for 20 or 30 years. The other important thing about a call period is that it promotes a very orderly market. It actually encourages the market to calm down because we've stopped trading, takes the volatility out because we're bringing everyone together to trade at that one price. Whereas quite often in terms of volatility, that's caused by a large order which is moving the market very rapidly. And quite often after a period of volatility, you see it revert back again. So the whole idea is that an auction helps to calm down the market. These are really the key reasons, that orderly bringing together of the market. That's why auctions are very popular throughout the world in terms of opening and closing prices. Also, again, in terms of reference prices, very popular to do that because, again, people see this as a fair way of valuing the stocks. Now, we touched on it a little bit earlier. I mentioned something called the EDSP auction. So that stands for the Exchange Delivery Settlement Price, which is a very posh way of basically saying it's the price at which derivatives are valued. So as I'm sure many of you are aware, we have a number of futures and options around our stocks and indices. And what we do is we have a special auction, which is on the third Friday of each month, where we actually have a valuation auction for those derivatives. Again, the reason why the auction is popular is because it brings together everyone at one point, at one time, and it's seen as a fair way of valuing the stock. Auctions are also sometimes used in terms of intraday. So for example, in Germany, the Germans have an auction at 12 o'clock. And again, it's just to their minds, it's a way of actually taking a fair valuation of the market at midday. As some of you may be aware, the London Stock Exchange is also going to be introducing an intraday auction at 12 o'clock. The release is planned for February, and I'll be talking about that again a little more in a few minutes. Volatility interruptions. Now, that's something which obviously has become more of an issue over the past few years, particularly if any of you are aware of the flash crash and obviously the court case which is currently going on at the moment. Sorry, hold on. And again, so in terms of volatility interruptions, the stock exchange, as well as many other exchanges, operates a number of what we call circuit breakers, which is basically volatility thresholds at which we trigger an auction. So for example, for most FTSE 100 names, if an individual order enters the market, which is going to move the market by more than 3%, we stop the market and we put it into an auction. Or if the price of the stock moves by more than 7% up or down from the open, again, we trigger what we call a volatility auction. So basically, volatility auction, we stop the market for about a 5-minute call period and then restart it with an auction. And the reason for that is to avoid flash crashes, et cetera. So as many of you are aware, back in 2010, there was a massive dislocation in the US market because they didn't have these circuit breakers in place. So the market was able to completely tank and then rise up again. On the London Stock Exchange, that couldn't happen because of our circuit breakers. The chart that you see here is going to be very similar to the chart that you saw earlier. And the reason for that is the FTSE 100 really dominates in terms of our set statistics. But the reason I'm showing you this is a little bit later, in the next few minutes, I'm going to be highlighting some trends in terms of auctions and how the popularity, if you like, of auctions differs as you go down the market cap curve. So the trend that you're going to be seeing during this speech is that auctions tend to be more popular in the more liquid securities and less popular in the less liquid securities. And at the end of the speech, I'll explain to you why that is. So how does an auction actually work? The mechanics of it, so here I'm giving you the example of how our intraday auction will work when we introduce it in February. But the mechanics behind every single auction is the same. It's only that the timings are different. So here with the intraday auction, it'll start at 12 o'clock. The call period will last for 2 minutes. So basically, we'll stop trading the set securities for 2 minutes. We'll collect in all of the buys and sells. And then the idea is that it uncrosses just after 12:02. Now, with every auction, there's a 30-second random period after the official stop to the call period. The reason for this is to promote a little more stability and also act as a safety mechanism for the auction. So if you like, this is really designed to stop any so-called spoofing, which you may have heard about, or any attempts to manipulation. Now, obviously, we have a surveillance team who are constantly on the lookout for any sort of nefarious types of behavior or trading tactics, but we always believe that prevention is better than cure. So by adding this randomized 30-second period, so it could be, one day it could be at 12:02 and 1 second, next day it might be at 12:02 or 15 seconds. By adding that little bit of a random period, it makes any attempts for spoofing much more difficult. Now, during this call period, we run what we call an uncrossing algorithm. So the idea of the uncrossing algorithm is to calculate the price at which we can trade the greatest number of shares. Okay, so this is really the key to an auction. So we're not out to try to find the price at which the highest price where we can trade or the lowest price, but the most popular price. And this is really why we say that auctions are a very democratic way of valuing a stock, because what we're trying to find is, at one place at one time, where does the market actually value that stock? Now, in terms of the auction, there's probably a couple other things I should add on there. So you can see here at 12:02 in a few seconds is usually when we uncross. But there is the potential for actually extensions. And again, the reason for those extensions is to promote an orderly market. There are two types of extensions that we can see to an auction. One is called a market order imbalance. So that's basically where we have a situation where we might have a large market order that's come into the market which hasn't been satisfied. If that order hasn't been satisfied, we'll go into a 2-minute extension. So the uncross will be delayed by 2 minutes. The market will be notified by an automated announcement, just basically saying, okay, this stock, and remember, this is all done by stock basis, so it's not the whole market, but this stock has gone into extended auction. The other trigger which may happen for an auction, again, is volatility interruption. So say, for example, we have on a set stock, we come out of the auction at, or we look like we're going to come out of the auction at 12:02 at a price which is, in the case of a large cap set security, 1% away from the last print before we went to the auction. We'll then actually extend the auction by another 5 minutes. And the reason for this is to, again, make sure that any price that we come up with is a legitimate price. So basically what would happen there, so say, for example, it looks like that BP was going to uncross at, say, 4% up on the last price before we went to the auction. We're going to delay that uncrossing for another 5 minutes, allow more orders to come into the auction, and they'll hopefully find a better price at which we're going to trade. Now, it could be that it actually, news came out during the auction, say news came out at 12:01. Well, in that case, what will happen is that we'll have two possible extensions to the auction. So it'll go 5-minute extension, and then if we're still looking to uncross outside of our volatility threshold, which again is set stock by stock, but for BP it would be 1%, we'll delay by another 5 minutes. If we are still going to uncross outside of that, we'll go ahead and let that happen. But the whole idea behind this is to make sure it's very orderly. And bear in mind, during these extensions, our surveillance team will be phoning around the market. They'll be phoning key brokers, asking them, okay, why is this stock uncrossing at this price? Is there a legitimate reason? What is your view? And make sure that, as I say, that the uncrossing price that we come up with is a very orderly and fair price for the market. Here on the chart here, it takes you through some of the regularly scheduled auctions that we have in terms of set securities. So as you can see here, we have an opening auction. The call period for that auction starts at 7:50, and then the ending time for it is 8 o'clock plus, again, that random 30 seconds. The EDSP auction, which we touched on earlier, so that, again, in terms of settlement price for options and derivatives, that's on the third Friday of each month, starts at 10:10 with an uncross at 10:15. The intraday auction, which I touched on again, will start at 12 o'clock in February with an uncrossed price at 12:02. And then our closing auction, which, as we saw earlier, the most popular auction that we have during the day. The call period starts at 4:30 with an uncross at 435. And then obviously in addition to this, as I touched on earlier, if we ever have any volatility circuit breakers going off, we'll automatically go into an auction, a volatility auction, and hopefully uncross 5 minutes later. So why are auctions used? Why are they popular? I think we've already touched on a few of the reasons as we went through the mechanics of the auctions. As I touched on a number of times, they remove volatility out of the market. And this is one of the things that's very, very popular with fund managers. It just calms the market down. We'll also see that it's a very popular way throughout the world, not just on the LSE, to open and close the market. We have in the past, now we haven't always opened and closed the market using an auction. In the past, we have tried other mechanisms such as the last or first print, also the average price over maybe the last or first 5 or 10 minutes. The problem with those approaches we found was that they almost promoted volatility. Quite often, particularly as you went into the close, when we had closing on last price, you would suddenly see a lot of trading happening in the last 3 minutes where everyone's trying to get that final price to set the closing price. Also, so that's when we moved on to an average price over the last 10 minutes, which took a bit of volatility out of the market, but we found it wasn't actually, feedback that we had from fund managers, it wasn't actually a very fair democratic way of trading. Because fund managers turn around and say, well, look, I'm being benchmarked at a closing price. I want to be able to trade at a closing price. But if it's an average price over a day, it's very difficult for us to actually hit a closing price, which is why we came up with the auction process. Again, because everybody can come together, trade at the same time, and get the same price. Volatility, again, is the removal of volatility out of the market is why we use them for the circuit breakers, because that call period where we actually stop trading just calms that market down a little bit. And another reason for using auctions, which is becoming quite topical at the moment, some of you may have heard of dark pools. Dark pools traditionally tend to be skewed more towards the institutional investor. We don't see individual investors take part in dark pools very often. Dark pools are a way of trading away from the order book, off order book if you like, but at market prices. These have been very popular with fund managers, again, for trying to trade in terms of larger size. But there are some new regulations coming in 2017, which is going to really put some restrictions around the use of dark pools, which is why we've had a number of fund managers come to us and start saying, well, look, auctions have become more popular, and it's one of the driving reasons why we're introducing the intraday auction at 12 o'clock. Because it's actually, for a lot of European fund managers, anyone who's managing money pan-Europe, they're saying, well, actually, you've already got a German auction at 12 o'clock. If you have an LSE auction along that at the same time, it starts to encourage people to think about trading their liquidity at an intraday auction rather than in a dark pool, which, as we say, is going to start having some new regulations coming around this. In terms of the chart here, so going back to that trend I was talking about earlier, why highlighting that auctions tend to be more popular for the more liquid names. You can see in terms of the closing auction, in terms of FTSE 250 and comparing it to FTSE 100, they're both about the same. You're both talking around about 25%. But there's a dramatic reduction in terms of popularity around that EDSP auction, the settlement price auction. And again, that's simply because options and derivatives on the FTSE 100 tend to be much more popular than on the FTSE 250. And then again, you can see down there, the opening auction is a little less popular. Only about 0.5% of a day's volume takes place in terms of FTSE 250 securities in the opening auction. So recapping, so why would you, as an individual investor, might be interested in using an auction? Again, it's because we're bringing together a large number of buyers and sellers at one time. So you get that aggregation. You get that confidence that you're actually trading at a fair market value for the stock, which again is why it's so popular with fund managers. For those of you who might be trading in larger size, and again in the next slide you'll see the average trade sizes and average order sizes for auctions. These are definitely much bigger. And again, so in terms of your market impact that you might be having, it's a good way to be able to trade larger trades with lower market impact. As we've said many times before, very popular with fund managers, valuing their portfolios, valuing the index, also in terms of being able to trade their larger orders with minimal market impact. And perhaps most importantly, that point I made it earlier at the beginning of the speech, 3%, so auctions tape represents just 3% of the trading day, and yet you can see as much as 25% of the daily volume trading in these auctions. So that's sort of a recap on why you might be interested in auctions. This chart here, looking at the FTSE 350, you can see, so in terms of the closing auctions, they're not so popular, only 17%. Hardly anything trades in the opening auction. We get nothing in the EDSP auction. So why is it when we come down the market cap curve that we start seeing auctions become less and less popular? Well, the answer to that goes back to the beginning of the speech when I talked about how the individual investor is basically unaware of auctions and aren't using them in their day-to-day trading. As you come down the market cap curve, the percentage of the market traded by the individual investor goes up. So for example, the individual investor probably represents about 2% of trading in a FTSE 100 name. But when you get down to some of these AIM stocks, it's as much as 20, maybe 25% of volume. And because the individual investors aren't really aware of the auctions, they're not using, which you can see here. So hopefully today, through this speech, we've given you a little more background in terms of how the auctions work, and perhaps we might tempt one or two of you into actually using them, if they're deemed appropriate, obviously, for your investment strategy. So if you're interested, what do you do next? I mean, first and foremost, we always say, talk to your broker. And when you talk to your broker, you want to ask them two things. I mean, first and foremost, do they actually offer access to auctions? Not all brokers do. So if the answer there is no, your conversation is basically over, and maybe move on to your next broker. But the next question is very important. Is really, are auctions actually suitable to your trading strategy? Not just actually your investment strategy, but also in terms of the stock that you're trading as well. Because bear in mind, remember, as we talked about the varying liquidity in the auctions and how the lower cap names don't see as much volume in the closing auction, you want to make sure that if you do choose to trade in the auction, that it's actually suitable for the size of your order and what you're trying to achieve. Now I'm just having a look here. It looks like we've got another 5 to 10 minutes. Very happy to take any questions that you might have in terms of how auctions work or in the mechanics of these auctions. Otherwise, you can always find me on the LSE stand later today. I think we've got quite, yep.
Yeah, is there any reason you would choose not to participate in the auctions, particularly the closing auction? Is it mainly that you're worried about being a large proportion of the volume at that point?
I would say unless you're a very, very large investor, that probably wouldn't be a concern. I think the reasons why you might not want to trade an auction is timing. Let's be honest. There are at discrete points during the day. It might also be that you have, for example, in your investment strategy, you have a specific price point at which you want to trade. If you go in with a price limit into an auction and the auction doesn't cross at a suitable level for that, you might not get a fill. So those are sort of things that you might want to be thinking about in terms of using auctions. Although I will qualify that a little bit. Again, I was thinking about the larger cap names. If you're trading in a smaller cap stock in an auction, I do encourage you to study the auction volumes that are actually traded for that stock, just to make sure, as you say, that you're not, you don't have the chance of perhaps outsizing the market. Oh, you've got another? Yeah. Yes.
I wonder if you could just tell us a little bit about market makers and price discovery. Perhaps put that in the context of these auctions. Thanks.
Okay, that's a good one. So again, so what we've been talking about here is about our SETS platform, which is an order book-driven platform where all of the participants come together. In terms of market makers, you could argue, also act in a way like an auction, because what they're doing is they're collecting in orders from their clients, aggregating them, and trying to find the best way to trade on behalf of all of them together. the reason why we have market makers versus sometimes some of the sets platform, again, goes down to market liquidity. So for the less liquid names, the smaller cap names, the market maker basically acts as a source of liquidity for the market. So they're up there offering liquidity to the market, offering the individual investor to buy or sell at set prices. On electronic order book, you see and you take part in the market directly. So for example, if you want to buy say 10,000 shares of BP, you can do that straight away on an order book. If you want to buy 10,000 shares in a less liquid name, there might not be that amount available in the market at the moment. And that's where the market maker steps in and says, well, you know what? I will sell you that 10,000 shares here and now, and then I'll worry about the risk and trying to trade out of that later. I'm confident that I should, on average, be able to get at least the price that you're paying me. Maybe I might, if I'm a smart market maker, might get a little bit better, but I'm happy to provide you with that liquidity here and now. So that's really the difference, I suppose, between the sets platform and the market maker platform. Sets platform, the market itself is providing liquidity. On the market makers, it's the market makers that are giving you that liquidity. I think we've got time for one more, maybe two more.
Hi. Just a quick question. Would these auctions lessen the impact of something like they had in Wall Street a few years, the flash crash,
Exactly.
caused by computer trading?
Correct. Absolutely right. So as we were talking earlier, so in terms of continuous trading, we have what we call circuit breakers, which are basically tripwires. If the market becomes too volatile, if it trips one of these circuit breakers, we stop the market and we put it into an auction. And we do this on an individual stock basis, but it's perfectly feasible. In terms of the flash crash, we had a lot of orders coming up all at the same time. What would simply happen in our case is a lot of stocks at the same time would go into a volatility interruption. In that point in time, our surveillance team, as soon as we see something trigger, they're straight away onto that, figuring out why did it trip, and who caused the trip. So for example, if it was a specific broker who, in my previous experience in the past, where someone suddenly accidentally put out a very large portfolio when they didn't mean to, they fat-fingered, we stop it straight away. We get on to them and say, well, look, you better cancel all of those orders, get out of the market. We're going to restart the market in 5 minutes. All of this, bear in mind, all of this is done automatically, but there's always a human element going on, particularly, as I say, in terms of a volatility interruption. Our surveillance team are always straight away on top of that, phoning around saying, well, look, what caused this? Let's make sure it's corrected before we take it back out of the, with an auction. So. Oh.
Probably a very simple question. Assuming that I have access to, to auctions through my broker, could you give me an example? Say, in what way will I benefit if I were to buy the 100,000 Barclays shares? Will I benefit, and at what point will I actually do it?
Okay, certainly. So again, it all really depends on what sort of deal you have with your broker, et cetera. But if we go through, and actually this last chart, we didn't touch on it, is a good example of what I'm going to talk about here. So say, for example, you had a large order in Barclays, 100,000 shares. If you trade that in continuous trading, if you look down here at the chart, the average trade size during normal trade is about £5,500. The average order size in an auction is around £45,000 to £50,000. And remember, in an auction, though, you're going to be trading in one shape. So you get one price, one fill. In continuous trading, based on £5,500 per trade, you're going to be trading a lot of times. Depending on what deal you have with your broker, you might be paying per execution. So you've got several executions in continuous trading, you have one execution in the auction. The thing to bear in mind about the auctions now, I know I made the point earlier, is that bear in mind you are trading at a discrete point in time. So for example, if, 3 o'clock in the afternoon, you see the price and say, that's a fantastic price in Barclays, I want to get that now, then absolutely you should be trading that now. Don't wait for the closing auction, because who knows where it might be trading an hour and a half later. So really the whole purpose, I guess, or the value in terms of the auction, number of executions. There's also, it depends how familiar you are with the stock and how long you can be investing in that stock. So for example, if you turn around and say, well, look, I've done some reading on Barclays. I think this is the right investment for me. I think this is going to be great in 5 years' time. It really suits my portfolio. I'm really not sure if it's fairly valued now. I've had a look at it, read about it. I don't really have a specific price. If you're unsure about it and you want to be certain that you're actually executing at a fair price, the auction is a great way to do it because you've got so many people coming together at that one point in time. But as I say, on the other hand, if you have a strategy which says, well, actually, I want to own it at X, you're probably better trying, if you like, a different strategy. So I would say two things. Valuation, if you want, make sure it's a fair valuation, you're not sure of the valuation yourself. And secondly, in terms of number of executions, number of trades you actually have to do in order to get that bigger trade done. One more question. Yep. If we got.
It's not.
There we go.
Hiya. Given that these are quite infrequent events for a fund manager, so they're only taking place twice a day, can you explain to us why the opening auction is almost shunned by them and they're very, very keen to take part in the closing auction? And what are the pros and cons of using either for a private investor based on your answer to the first part?
I mean, that's a good question. So why is this volume so low at the beginning of the day? Traditionally, and this has been the way that the market has been for, since I've been trading, so that goes back, late 90s. The market's always a little bit slow to get going. Part of the reason for that is that people are still digesting overnight news, any sort of overnight moves, etc. But there's also, particularly when you think about fund managers, there's the impact of the U.S. investor. The U.S. investors tend to start trading. They tend to start coming online around noon. And if you look at our volume curve over the day, you always see that first hour of trading is very light. Even putting the auction to one side, in terms of the percentage of volume taking part in the day, it's very, very slow to start. And we see an acceleration as we go into the afternoon. Again, I have to underline because as a stock exchange, we can't advise in terms of appropriate strategies in terms of individuals would take. But if you're asking me as an individual investor, which one would I prefer? I would probably say the closing auction. As you say, simply because the volume that's going on there. I do use the closing auction when I invest, if I'm honest with you. And again, it's because sometimes I can't watch the market all day. I've got a full-time job. I want to make sure that I get a fair price. So I just say to them, look, can you just buy this or sell this for me in the closing auction? Look, I'm sorry, I'm being waved at. Time's up. But if you have any other questions, I'm on the stand. And in fact, we'll be going through this talk again in about half an hour's time. Thank you very much. Thank you.